Dosto, welcome back. It's day 29 of our 30-day explainer series, and today we're tackling something huge. We're going to solve the ultimate retail trader frustration. We're getting into mastering range trading through option selling. Basically, how to turn the most boring sideways days in the market into your absolute biggest payday.
I mean, seriously, have you ever placed a trade, heart-pounding, totally expecting a massive move, and then watched the market just stop? Like it doesn't go up, it doesn't go down, it just goes sideways while your option premiums literally melt away to zero. It's so frustrating, right? Well, today we're going to completely flip the script so that you are the one collecting that melting money.
Okay, so here's the game plan for today's explainer. We're covering the sideways market trap, becoming the insurance company, calculating the safety zone, the magic of time decay, and finally, managing black swan risks. Let's dive in.
Part 1. The Sideways Market Trap. Look, most people start their trading journey by buying options, mainly because it's cheap. You throw in a few bucks, desperately hoping for a massive breakout or a sudden crash to multiply your cash.
But here's where the hard data totally blows that strategy out of the water. Check this out. The market actually stays in a boring, non-directional, sideways range about 70% of the time. That means if you're constantly buying options, hoping for a huge trend, you're literally fighting the natural state of the market 70% of the time. You're trying to force momentum where there's absolutely none.
Moving to Section 2, becoming the insurance company. To survive this game, we need a complete paradigm shift away from that gambling mentality. Instead of being the option buyer, crossing your fingers for a miracle move that only happens, 30% of the time, you need to start acting like an insurance company. Think about it. An insurance company sells protection and collects a premium upfront. They absolutely do not want a disaster to happen. They want things to stay perfectly, predictably normal. As an option seller, you're selling that exact same protection to other traders. You're essentially stepping into the role of the house. You collect the premium immediately. And if the market just stays within the boundaries you set, if it just stays boring, you get to keep that upfront premium as pure profit.
All right, Section 3, Calculating the Safety Zone. Let's look at the real math here and see how this builds using a practical example with Ethereum on a platform like CoinSwitch Pro.
So let's say Ethereum is currently trading around $2,127. If you pull up the options chain for next month, you might see a call option premium sitting at $228 and a put option premium at $192. Just take a second to digest that. That right there is the premium other traders are more than happy to pay you right now.
The absolutely crucial point here is that if you sell both sides in a classic range trading strategy, you immediately collect a total of $420 up front. Boom, that's cash injected directly into your account from minute one. And this brilliantly shows how we calculate our safety zone. It's super simple arithmetic. You take the current price of $2,127, add that $420 premium to get your upper limit of $2,547. Then, you just subtract that same $420 from the current price to get your lower limit of $1,707. Look at the size of that buffer. That gives you a massive 50% profit range. As long as Ethereum stays anywhere between $1,707 and $2,547, you are making money. While everyone else is chewing their fingernails, waiting for some crazy surge or drop, you're just happily profiting from a boring, sideways market. Which brings us to Section 4, the magic of time decay. The mechanism that actually puts this money into your pocket is something professional traders absolutely love. It's called time decay. Every single day the market stays quiet and avoids a massive move, the value of those options slowly melts down. And guess what? That melting premium goes straight into your pocket as the seller. You're not trying to predict the future, you are literally just getting paid for the passage of time. Finally, Section 5, managing black swan risks. Because, look, with great power comes great responsibility. Option selling requires a really strict defense. You absolutely must have a plan for black swan events. The market is quiet right up until it isn't. Things like sudden emergency fuel price updates, an unexpected rejection of a peace proposal, or massive spikes in geopolitical volatility. Any of these can break your carefully calculated range in a heartbeat.
This is exactly why we spent day 24 of this explainer learning all about hedging to protect your capital. You have to know your maximum risk before you ever hit that sell button. Protect your downside, and the upside will take care of itself.
Well, guys, we have only one day left in our series. Open up your account on CoinSwitch Pro or Delta Exchange to practice this stuff.
You can even claim some starting credits on CoinSwitch to get going. And hey, if this math clicked for you today, be sure to share this explainer with your fellow traders so they can stop bleeding money too.
So, I'll leave you with this. Are you going to keep chasing momentum that only shows up 30% of the time? Or are you ready to become the insurance company, collect the premium, and actually play the probabilities? Stop losing money to time decay, start using it to your advantage. I will see you tomorrow for our grand finale, Dosto. Go self-made.